All right. Good afternoon, everyone. I'd like to thank you for joining today's Bright Talks, brought to you by Sun Life Asset Management. My name is Monos Mena, and I'll be your host for this event. For this event, our topic is diversifying into global funds. What an exciting past couple of years it has been for our global markets. With the pandemic rally of the tech stocks in 2020 to 2021, and its correction in 2022 due to the Russia-Ukraine war, rising inflation, and rising central bank interest rates. And its rebound in 2023, as you can see in the screen, with the rise of the Magnificent Seven, with NVIDIA leading the AI tech rally, which continues to be the driving force of the global equity rally this year, 2024. Now, given that there was a bit of market volatility just around 2 weeks ago, this did not stop the ascent of the global market stock rally. Now, since last year, the entire global investing world has been waiting for the US Federal Reserve to cut interest rates. And just last Friday at Jackson Hole, Wyoming, finally, Fed Chair Jerome Powell finally said that it is about time for the Fed to cut interest rates. Will this be the start of the next leg of the global stock market rally, or has the market already priced these in? Today, we'll take a deep dive into that, and our special guest speaker will help us navigate what is going on in the markets and how you can capitalize on these market opportunities. Jimmy Weng is the head of Equities Asia for Sun Life Assurance Company of Canada, where he oversees Sun Life's public equities portfolios in Asia. He leads a regional team of 18 equity-focused professionals across the region with investments locally and globally. Prior to joining Sun Life in 2019, Jimmy led offshore long-only equity investments for ICBC Credit Suisse Asset Management and co-founded an equity long-short hedge fund, Genesis Capital. He started his career with Morgan Stanley in Hong Kong. Jimmy has an MBA from the Harvard Business School and a BS in Finance and Accounting from Northeastern University, where he graduated summa cum laude. Hi, Jimmy, you have the floor.
Great. Thank you for that introduction, Mon. So I think I wanted to start really with the first slide here on the performance quilt because it's one of my favorite ways to show and explain diversification benefits. This has the benefit of hindsight, obviously, and the numbers itself really kind of just speak to it. It basically it sells the performance without really having any forecasts or any remarks on it. So if you look into the details here, these are total returns by calendar year over the last 10 years. You could see that, each individual market, and we have a number of markets here, including the Philippines, Indonesia, Vietnam, US, Europe, Japan. We also have regional indices here, so Asia ex-Japan, ASEAN markets, and also MSCI ACWI Global. And ACWI actually stands for All Country World Indices. So that's essentially the world global index that, we're referring to as we speak about global funds, today. And so, I wanted to kind of highlight here, as you could look past, each individual year over the last 10 years, that it's actually been quite volatile, right? You see that, Malaysia is doing quite well this year, but last year was negative performance. You look at US, basically has been riding on a very strong AI theme over this year and last year. But you look back in 2022, it's actually had negative performance, given macro conditions, COVID rate hikes. And then you see overall ASEAN markets haven't been doing very well for a number of years. But then we just saw one of the strongest months, in August to date, with the change in the Fed messaging. So I think, the key message here is that, a global diversified portfolio, really being able to capture, all the markets and diversifying that risk over the long term does deliver, a better risk-adjusted return for its clients and also for investors. What you really want to see and look at, here is kind of like portfolio management. You're delivering above average returns on a relative basis, over the long term, and generally you will come out as a top quartile over the long term and over time. And so, you could see that, the global ACWI index we're referring to has delivered, roughly about 10% annualized over the last 10 years. while individual markets have generally have been, have been lower than that. While U.S. markets have been performing quite strong. The other thing I want to highlight here is also the emotional swings that's tended to hurt investors during volatile markets. So, Mon, you've mentioned that there's a lot of volatility over the last 2, 3 weeks, something that we'll talk a little bit about, later in the presentation. But really here, it kind of just goes back to show that diversifying that risk, particularly within individual markets, is probably the best way. And also these crisis periods often present opportunities for long-term investors to take advantage of these lower value markets that we'd be able to invest into. So I think that's really the first slide I really want to highlight. It always kind of gives a very powerful message. It's my favorite way to kind of show diversification again, because, have that benefit of hindsight. But, we can always kind of go back to this. We could, definitely add more markets here. We could add different asset classes, but the message essentially is the same, that, diversification, especially with a global portfolio, aims to deliver better long-term risk-adjusted return. So I think, we talk a lot about, global assets, global portfolios. We talk about MSCI ACWI, roughly about 2/3 of that is invested in the U.S. markets. So I think on the next slide, we reference the emerging markets. Right. So emerging markets definitely has been an increasing part of that global growth. If you look in the past 20, 30 years, you could see that developed markets, US, Japan, UK, Europe, have really been dominating, as one of the basically the world's largest economies, measured in US dollars term. You look forward 20, 30, 40 years, you're seeing that a lot of the current emerging markets are actually going to be becoming increasingly part of that global growth. And by 2075, Goldman Sachs estimates was that actually currently the four emerging markets, China, India, Indonesia, Nigeria, actually would make up four of the largest five, economies in the world. And so when we talk a lot about, diversification, one of the key things to think about is also diversifying between developed and emerging markets. And maybe I should probably define, what these terms, generally mean. I mentioned that MSCI ACWI All Country World Index is a free float weighted equity index, 2/3 of that making up US markets, but it has both developed and emerging. Now, characteristics of developed markets include more stable economies, high per capita income, liquid equity and debt markets, access to foreign investors, dependable regulatory system, and emerging markets generally is one that's transitioning into the developed, economy. And so I think, when you invest into emerging markets, there's risk and rewards. The returns there can generally offer better returns over the long term, right, due to the rapid growth. But at the same time, and we've been seeing this over the last 10 years, is that emerging markets also have a lot of risk inherent in them, particularly with political instability in certain key markets, infrastructure problems, currency volatility, illiquidity in key markets. And so that really gives the, certain emerging markets a discount compared to the developed markets. But over time, as you could see over the, the forecast, especially with here, you could see it with Goldman Sachs, is that over the next, long-term 20, 30, 40-year period, we should see emerging markets continue to grow. The ecosystem among these emerging markets tend to be beneficial, especially when we see global growth continue to be positive. And so we should probably think about emerging markets as part of a well-diversified, portfolio, in addition to, US and developed markets that we, currently have very large exposures to within the current MSCI ACWI index. The next slide will go into a little bit of what the volatility, last few, weeks have basically meant. So, we talk about diversification, we talk about, the past 10-year performances, we talk about developed and emerging markets. And I think, over the short term, I think there's a lot of questions as to, what essentially happened, and is it time for rotating? Is this basically a regime shift? I think, what we saw in the past couple of weeks was the market is resetting its growth expectations. Not really a resetting for a hard landing or recession or negative earnings growth expectation. I think we're still maintaining our base case where we're still quite optimistic, particularly with the Fed changing its messaging for policy adjustment. that we should have a soft landing within the U.S. economy. We're not seeing a short-term recession, and we're still seeing very positive earnings growth, and that's generally good for equities. So I'll go into a little bit of detail as to what really triggered, this volatility and the sharp sell-off. And over the last few weeks, as many of you have seen, we've seen the rebound within equity markets as the volatility has come down, and I think investors start to realize that we should not overreact, right, to certain numbers that come out on print, or perhaps any figures that get misinterpreted. One of the key things that get misinterpreted or misunderstood is essentially the unemployment jobs report, perhaps even leading to a recession indication. And also, having talks about an emergency rate cut in order to save the economy. I think these are, again, opportunities that present itself, especially for portfolio managers and investors to take advantage, when fundamentals detach itself, from the price. And so when you saw the July jobs report coming out earlier this month, unemployment was showing an increase from 4.1 to 4.3, US adding a lower than expected number of jobs, basically signaling a slowdown. One of the key things we want to ask ourselves is, what does this mean, right? On an absolute level, number basis, 4.3% is still quite, is a full employment picture. But more importantly, why was there an uptick in the increase? Generally, there has been a slowdown, but it has been very much a supply driven. And so what does that supply driven mean? Normally during a recessionary period, there's a weakening demand for workers, right? Essentially as recession, kind of builds up and the economy is not doing very well. But during a supply-driven increase, there's more workers in the workforce. There's more labor looking for work. There's more immigration, within the U.S. And so there's actually bumping up the unemployment figure because there's more people looking for work. And that to me is basically a sign of an economy that's still doing very well. I think that the underemployment or even the unemployed starting to look for work is actually a positive sign that there are opportunities, especially when the number is still at a very comfortable level. But that being said, Chairman Powell, the Fed has stated that it's a time to adjust the policy. The direction of travel is very clear. I think the markets have welcomed that response. But one of the key things to note is that the timing and the pace continues to be dependent on data outlook and the balance of the risk. But one of the key things about recession, I think one of the things about recession, maybe I'll also highlight, definition of recession. The technical definition of recession is 2 consecutive quarters of negative GDP growth, right? Real GDP inflation adjusted. But in recession definition generally is used very loosely. And I think that the term should be more a broad-based decline in economic activity, an increase in unemployment, along with declines in company earnings, and also a lower outlook with declines in share prices, and asset classes. And so it's a very broad-based definition that when we talk about the word recession, I think you're going to hear recession a lot, because I think that's the key risk, among the U.S. markets as to how the Fed will basically protect its economy from a recession. Are we heading towards a soft or hard landing? And I think that, the recession definition used here is very broadly, kind of termed. And so when we talk about unemployment, one of the key things that people have talked about was whether we're heading towards a recession due to unemployment rate. But, as I've mentioned earlier, the increase in supply, the absolute figure, and I think that the weaker labor, demand should probably be something that should not be signaled as a recession, but perhaps something that is more notable as to an increase of supply, so the U.S. economy is still running quite strong. So I think that's what I'll probably say about the U.S. economy in particular. That was one of the key factors that have created a number of volatility, within equity markets, and also impact on the Fed. The next slide goes a little bit into the other reasons as to why there was some volatility in the equity markets over the last couple of weeks. If you could go to the next slide. All right. So the other 2 reasons I mentioned was on U.S. tech. And so we have seen a sell-off or perhaps a risk-off profit taking within a lot of U.S. technology companies. given the outlook and expectations and guidance that they have announced. And so, by now, end of August, actually, most of S&P companies have reported earnings growth are actually coming ahead of expectations. But what were some of the key risks is essentially that Microsoft, Amazon, Alphabet, and Meta, four of the, key technology companies, and I'll just use this as an example, are combined to spend an estimated $52 billion in capex. Actually, that's the number that they've spent, in second quarter. That's a 54% year-over-year growth, up from 30% year-over-year growth. And so I think when there is an increase in capex spending among these technology companies, and then perhaps the outlook is not as clear as to how you're going to monetize that AI technology, there becomes more of a profit-taking concern as to when we would basically be able to realize the value and reflect that in the share prices, given that technology companies are trading at a higher multiple than historical averages. And so I think the guidance is one of the key contributing factors, that the business was unclear with a consistent message within the earnings calls that AI technology would deliver value and benefits over a longer period of time. So the key question is, AI and technology companies are delivering earnings, but over the longer period of time. So the question is, how long is long? But essentially, the bottom line that I want to highlight here is that market expectations are being reset, as I mentioned. The earnings expectations for this year for US markets are still growing at 10% year over year. Historically, earnings growth has been highly correlated with positive returns, and which is what you see that S&P and US technology companies have come back and bounced back quite nicely after some of its sell-offs. And then finally, I think Japan's interest rate hike and hawkish statements is one thing that I'll also mention. The Japan carry trade is one that I like to term more of a crowded trade, where essentially you would be borrowing from countries with lower rates and basically investing into countries with higher yields and higher rates, basically to generate higher returns. But one of the things that I'll highlight here are these are speculative trades. This was due to the rapid appreciation of the yen that affected certain performance of exporting countries, and also traders that have been speculating on currency remaining low. However, what we again go back to is the fundamentals, and what we don't see is any change to Japan's economy and corporate fundamentals, which we see as quite strong. And I think we'll talk a little bit about why we're overweight certain markets later on in this presentation. Right. So I think that's what I want to talk about for the the short-term volatility of what we saw in the last few weeks. One of the key message takeaways is that again we're resetting growth expectations, but our base case is still seeing that we have positive earnings growth, and we're still quite optimistic on the equity markets. As we've seen on the first slide, 2024 is actually quite positive year for equity markets overall. And so what we try to keep focused on is essentially the outlook. So the next slide will go a little bit into what we think about key markets. Global markets, I mentioned we're positive on global growth, positive earnings expectations. You can see in the bottom, these are basically consensus numbers. Key developed markets, emerging markets, ASEAN markets, overall for the next 2-3 years, we are seeing about roughly a 3% GDP growth forecast. And you can see a breakdown across different key markets. Emerging markets, ASEAN, Philippines, Vietnam, India, really have been the key markets that are driving a lot of that growth, being essentially offset by China, that has been seeing more domestic struggles and economic concerns there. But overall, US, we see a softening, but not a hard landing that I mentioned. Unemployment is cooling, but in my opinion, what we saw from the Fed messaging that we're expecting, a pivot, really would not have happened as quickly, and the market would not have welcomed if we didn't see these concerns basically coming up. So one of the key signals for me personally is, as these, I'd say volatility or crisis, periods or concerns basically happen, look at how the Fed or look at how the central bank reacts. And so when the Fed basically comes out and basically is putting a floor on the crises and saying, we're here to support the markets, we're here to cut rates as necessary to support growth, that's something that is very positive for asset prices and particularly for equity markets, especially when we have a rate cycle rate cut cycle, coming in as a tailwind. The Eurozone, the outlook has been slightly below average, but also provides a defensive and diversified exposure to the US market. So much more industrial exposure versus US, a growing technology exposure. ASEAN markets, I mentioned, is a key beneficiary of the Fed rate cuts. And, this month is, a key example of that. In terms of economic growth, ASEAN remains one of the fastest growing in the region. One of the key positives, especially when we think about a turnaround within ASEAN markets, Philippines included, is the low foreign ownership, the discounted valuations, and the rotation into value, right, as the key positives. And so we definitely see that there are opportunities, within emerging markets, within ASEAN markets. Philippines, obviously, this month have seen a very strong rebound and a rally back to our year-end target prices. And so I think one of the key things is, for us to stay invested, remain diversified, really being able to capture, the positive returns that we're seeing both in emerging and developed as the cycle basically comes back. So it's very difficult to essentially time the top and the bottom, but staying invested within these markets and having a diversified approach and portfolio generally will offset that risk. And you've seen, again, back to the first slide, longer term, you definitely will have a much better balanced risk-adjusted portfolio. I'll mention very quickly, maybe China, we're still quite cautious, really due to the latest earnings results, signaling a very weak domestic economy, deflationary pressures, declines in home prices. But we are looking at perhaps some structural changes that may happen in the upcoming year as the government provides more support. And then in other Asian markets, we're a little bit more positive, particularly in India. Valuations, we think, that are trading at a premium, but it does reflect the country's healthy fundamentals and also its demographic profile. Wage increases, structural reforms, corporates also being constructive within the Japanese markets, definitely another market that we think is quite attractive for us, especially with corporate governance changes. And so I think when we talk about structural changes, we do a lot of analysis into whether this is a market that we want to stay invested over the long term. And so while valuations could be cheap, for example, in China, we haven't seen that turnaround in structural changes. Whereas for India and Japan in this case, we are starting to see more structural changes. And so that's a key market that we think that is a key part of a portfolio, especially within a global diversified portfolio. And then finally, for Taiwan, also another beneficiary of AI thematic, as well as Korea. And so when we think about diversification, it's not just within markets because there are correlations across markets. It's also by themes and also by sectors. And we'll go a little bit into that, a little bit later as well. The next slide I want to go into, very quickly. So equity markets, are they cheap? Are they expensive? We'd basically say that they're fairly valued, especially when you're thinking about its valuation compared to its historical 10-year period. But one key thing to note is that the return on equity, for a lot of these key markets, and when you think about return on equity, it's basically a company's, financial profitability, looking at net income over its, shareholder equity. That essentially have been improving along with its earnings growth. And so when you think about valuations, it's not purely on the price side, it's also on the earnings and the ROEs. And so when you think about breaking it down into sectors on the bottom side, you could see information technology sector as one of the main key drivers of that earnings growth. And so as your earnings continue to grow and it continues to beat expectations, the valuations will naturally come down. One of the key things to continuously look at is, we're not just looking at the overall market cap or the price of companies or sectors or markets. We're looking at the growth of the earnings, potential, and also the return on equity that these markets and companies are delivering. And so as long as the fundamentals are quite strong and they're quite healthy, and we're still seeing positive growth. For example, I mentioned 10% for SPX this year. That generally means a supporting factor for general equity markets. And so we generally would not look at purely on a valuation basis, but more fundamentally, are the valuations supported by the fundamentals? And a lot of these fundamentals go back to the earnings growth that we have been seeing expanding overall for a lot of the key markets that we talk about. And here you can see the MSCI ACWI continuing to grow quite nicely, especially with improving ROE. Next slide. So, given the recent volatility, I mentioned they always present opportunities with itself, right? So, we will look at the trailing 5-year ranges for a number of these technology companies, for the S&P 500, the NASDAQ. You could see there's a very wide range over the last 5 years. And, essentially when we're looking at the last 5-year range, we're looking at its current price to earnings ratio. And then we're looking at, what the average is. Essentially, with this, the current, basically sell down or profit taking, I should say, that essentially presented itself with a lot of opportunities for us to take advantage, right, of good quality companies and markets that have sold off, trading at a better valuation for us to enter into and invest over the long term. And why are we, quite optimistic and bullish, especially on, for example, the Mag 7, S&P 500 US markets here, for an example, you could see that the Mag 7 net income has actually been a key driver, right, of the overall S&P 500 net income growth. So, the Mag 7 overall has even been able to deliver higher earnings and forecast to deliver even higher earnings than the remaining 493 companies' net income on a year-over-year basis. And so you could see the significance of not only the valuations that have come down, but also the forecasted growth of earnings for technology companies. And that's why essentially the US and S&P, markets overall has been doing quite well, because it has been supported by fundamentals and it has not been purely just more of a speculative trade that investors are really just buying into a hype. And speaking of hype, I think the next slide will show, a comparison. Right here. So you can see a comparison from the dot-com era in 2000 versus currently. So a lot of, questions going back to, whether the technology sector is warranted, whether the outperformance will continue. Do we see very similar comparisons, to 2000 when we saw a dot-com bubble bust? And for us, we go back to, again, earnings and fundamentals, right? I think we will highlight that as a key discipline that, stock prices currently, they don't look detached from fundamentals, because during the tech bubble, you could see that the NASDAQ earnings over S&P earnings have basically been inflated. So there's been a detachment during the 2000 dot-com era where you've had an increase in price, but it hasn't been supported by earnings. Here, you're seeing a much stronger correlation that the improvement in the price and the share price and the market cap of these companies, right, increasingly, a number of $3 trillion companies basically coming up, within the U.S. markets, that has been supported really by, the earnings growth. And so, when we think about, currently the fundamentals are supporting the price improvement and also the price rallies, especially within the U.S. tech sector. And so I think, within that, on the right-hand side, we will always ask, well, which markets basically have giving a better risk-adjusted return profile. You could see that the NASDAQ has about 51% index weight in information technology, S&P 500 about 31%. The MSCI ACWI index, I mentioned our all-country world index, is about 25%. So it does give a pretty balanced, weighting within information technology, as well as other sectors like financials, healthcare, and consumers. One of the key underperformers, as we've highlighted here, within Philippines, is that you could see there really is no technology company to really be able to ride on that. So we see Korea being able to take advantage, Taiwan taking advantage, US obviously with its high increase, high weighting within technology within the NASDAQ and SPX. But, if you put in other markets like, ASEAN or the Philippines, much of these companies are more value oriented. And so more focused on, you could see here industrials, more focused on financials. I would call it more old economy sectors versus new economy growth sectors. And so I think, that's really where you're not seeing the excitement or the stronger growth within, the key companies that are underlying these key indices. And so that's really what we want to be thinking about when we start thinking about diversified portfolio. How much exposure do we want within a US market, within a Philippine market, within an Asia ex-Japan market, within DM versus EM? And I think the key or simplest way to take exposure to all of these key questions is really having exposure to the MSCI ACWI index, because the ACWI index has, again, both developed and emerging markets. And so I think that that's really one of the key benefits, right? If I may, to kind of go having a simple approach, having a simple diversified portfolio, benchmarking it to ACWI, and having, funds that are able to invest, according to, more of a global diversified portfolio rather than a single country. Because, you could have one year where particularly technology does very well, and you could have the next year where financials perhaps does very well because it's much more value versus growth. But I think, for investors, and for clients, I think this is definitely an opportunity where we should think about diversification to get the benefits of both value, growth, diversification across sectors, as well as, by country. I'll go into the next slide. If I could talk a little bit just about, the U.S. election cycle. So I think, heading into November, there's a lot of questions about politics and, which candidate, would be better. I think one of the key things when we look back historically, and here's the data, showing, the U.S. returns since 1936, is that a Democratic president with a split Congress has generally seen the highest returns. We're not seeing too much of a difference here. I think that really goes back to policy. But one of the key things for equity markets, whether it's a Republican or Democrat, is there clarity within the policy? Is there certainty as to how companies will continue to generate the earnings growth expectation? Or is there going to be a completely changed business model within particular sectors or particular companies that have a heavy weight within the indices? And so I think those are the real key questions. But just taking a reference from historical numbers that, split Congress has generally seen the highest returns, really just because it's much more status quo with a Democratic president that has been much more supportive of equity markets there. But one thing I would rather want to highlight more so is that profits are probably one more key. So which president, which Congress, senator, policy, is basically in-house or elected, we wanted to also take a look at what's the impact of that on EPS growth, like earnings per share. And that really had a much more significant, impact or signal on whether we were going to have a positive or negative year, for the equity market. So, political party, you could see Democrat 57% versus Republican 43%. But on a profit cycle basis, positive earnings, again, going back to earnings, growth and expectations, 67%, were positive on a positive EPS versus 33% on a negative. And so that's one of the key things that we'll keep an eye out, not just on the political party and the Congress, but also the earnings growth expectation as a result of the policies that are coming out from the, from the president and also from Congress. And the next slide is basically just going a little bit more into detail, but I'm not going to go into too much over here. The key matters really for the U.S. election is on, taxation, macroeconomy, immigration, trade, energy, antitrust regulations. You could see that there's, Democrat and Republican on the right. The severity of the impact would basically swing depending on the probability of, which party winning. But ultimately, one of the key things that we'll, again, want to highlight, especially with, with U.S. election, is that it goes back to policy, right? With Democratic Party, policy probably will be more of a continuity with, minor differences. We probably expect much more of the same, continuity of approaches, of personnel, focus on, sector protection, promotion on industries. I think competition with China particularly. And also one of the key things, within Democrat, I think it's U.S. plus allies versus the rest of the world. Whereas with Republicans it's quite clear that it's more of a U.S., right, versus the rest of the world. So what are some of the implications and policies that will come out of it, but not just the U.S. policies? How are other countries going to respond, right, to some things like that? For example, increase in tariffs, or, for example, for Republicans, much more of the policies are transactional, right? So what kind of transactions will take place? Trump 2.0, what kind of foreign policy will that look like? There's going to be increase of proposed tariffs, but that will be offset, right, through negotiation. So how that kind of plays out is really very difficult to tell at this point. But one of the key things to really highlight is, again, allies really thinking about together from a democratic space, but for Republicans is really more of a negotiation and transactional basis. So a lot to think about and a lot that's going to be coming out. I'm looking forward to the debate or potential debate that may or may not happen between Harris and Trump, but definitely look for clues as to what that means for from a policy perspective for other markets and also for our earnings growth, particularly for companies if there's any change in expectations, forecasts, and business models. And so I think with that, I'll leave it to the last slide. I think there's probably one more of the key takeaway. Hopefully, especially with the first, performance quilt, it really showed, that volatility crisis periods present itself with opportunities. Price movements often get detached from fundamentals, and those are the key, periods that you want to remain disciplined. You don't want to basically miss out on opportunities itself when you're able to basically buy at lower valuations, especially when there's really no change in fundamentals. And so remaining disciplined has always been a key fundamental trait, for portfolio managers and also for investors. Staying invested, right? Generating positive returns over the long term, not missing out on these attractive opportunities that I mentioned. And so, we definitely can look at rotating among countries, rotating among stocks, rotating among sectors, but generally staying invested over the long term, especially when we're seeing positive earnings growth and positive real GDP growth, is definitely also, quite important. And finally, the key message, I think for this talk is diversification, right? The global diversified portfolio has proven to offer better risk-adjusted returns over the long term. Very difficult to really tell which market is going to outperform which over the next year, the following year. You've seen that various markets have domestic issues, foreign flows, liquidity, constraints. And so, having a diversified approach with both developed and growing emerging markets is probably one of the safer and better ways to remain invested. And I think that really is able to capture the benefits as well as being able to diversify some of the risk, within key individual markets. So I think that's around all I want to say for this talk here. Discipline, staying invested, and diversification. Mon, happy to take questions or pass it over to you for the next section.
All right. Thank you for sharing your insights, Jimmy. And you may rest for now, and I'll call you back later for the Q&A.
Thank you.
And now to give us our house view and how we can manage our global funds portfolio, we've invited Nicole San Juan. Nicole is a global funds portfolio manager for Sun Life Investment Management and Trust Corporation, or SDIMTC, looking after the various global fund mandates, which includes equities and fixed income. Previously, she was a quantitative specialist creating and backtesting model portfolios. Prior to joining Sun Life, Nick was an associate portfolio manager at the Bank of the Philippine Islands, or BPI. She holds a bachelor's and master's degree in applied mathematics from Ateneo de Manila University, where she graduated with honors. Nick is also a CFA charter holder. Hello, Nick. You have the floor.
Hi, Mon. Good afternoon, everyone, and thank you, Jimmy, for that very informative market outlook. So now let's take a look at what the implications are for our Sun Life funds. So maybe to start, let's have a brief recap of what the key drivers that we're watching out for in global markets. So for global fixed income, the market is already widely expecting the Fed to start cutting rates in September by about 3 to 4 times. Debt levels in the U.S. continue to rise but still remain manageable. For equities, meanwhile, we see corporate earnings to be better this year than compared to last year, where it has been flat, and we expect to see this to be higher in 2025. We've already started to see some slowdown in the US, and this could support the Fed in cutting rates this year as we are seeing inflation trending lower. And also, the artificial intelligence theme has still a lot of room to grow as we see the benefits move up the value chain, also as discussed by Jimmy earlier. However, these doesn't come without downside risks, of course. So these are the risks that we're watching out for. For fixed income, geopolitical tensions have intensified in the past few weeks, and this could mean spread widening in terms of credit, right? For China, meanwhile, its growth continues to slow as the property market remains challenged. Meanwhile, U.S. elections are right around the corner, and we could see the yield curve steepen and increase in tariff risk, especially if Trump wins. And these are the same risks that we're seeing in the equity space, impacting the equity space. Mild recession remains in play, and this could lead to a slowdown in the top line growth of most corporations. And we've also seen the US market already rally to new all-time highs this year. So it poses the question, are market players starting to take profit already? So that's a quick snapshot of what we've been looking at in the market. And now, how do we use all these information and apply it to our fund life portfolios, right? So now the question becomes, how much are we actually exposed to these global market events? Well, for a local investor like you and me, it can be hard to switch a portion of our portfolios from the local market to global, especially as we tend to have what we call the home bias. Yeah. So this is our tendency to overinvest in our domestic equities or home markets, despite hearing all about the benefits of diversification outside our home country. And this is quite understandable, no? Since, of course, we're not too familiar with what's happening overseas, so we may not feel as comfortable investing in those markets. And as we see in this chart on the right side, although the text is may not be as legible, the Philippines is actually top four in terms of how much residents are investing in their local market. So it's about, if you're a Filipino with equity investments, almost 100% of your equities would be invested locally. So meanwhile, what's been highlighted in this tweet is Russian investors, which have 95% of their stock portfolios. So imagine being invested in the Russian stock market in 2022 when we saw their market drop by about 40%. So too much concentration risk in just one stock market. So one way we think to reduce that concentration risk is to broaden our sector exposure by investing globally. Right. So here we're showing a chart of the sector exposure of MSCI ACWI. As Jimmy mentioned, this is the barometer of global equities versus the PSCI sectors. So the yellow bars would be PSE. And as we see, it's concentrated in industrials and financials. So industrials would be your conglomerates, while financials would be your top three banks. Meanwhile, MSCI ACWI is more diversified. The top exposure would be in information technology, followed by financials. So, and other sectors that are top here would be healthcare as well as industrials. And here we notice that information technology and healthcare are actually not in the, hold on, let me try to.
Hello, is this audio better? Checking. Right, all right, great. Sorry about that. Okay, so as I was mentioning, global equities versus Philippine equity sector breakdown. The blue bars would be your global equity sectors. And we see here information technology and healthcare are present in the MSCI ACWI, but is not in our local stock market. So just thinking about what Jimmy mentioned earlier, if we see that the tech sector is the driver of, could be a strong driver of earnings expectations moving forward, then the only way to benefit from this would be to start investing offshore. Okay, so next slide, please. Right, and so here we present the a suite of SLAMC global funds which have exposure, which can be exposed to these factors that we've mentioned in varying degrees. So from left to right, those would be your moderate risk or balanced risk to a more aggressive portfolio. And this is mainly a function of the exposure to equities. So for example, for Dollar Wellspring, so it is a balanced fund of funds, which has about 30% invested in global equities and about 70% in fixed income and cash. So this is offered in US dollars. So about 30% of this portfolio would be invested in offshore markets. But if you want to take a more aggressive approach and be exposed more fully to the global equities, then you can go for the World Equity Index, which is denominated in peso, or World Voyager, which is an active equity fund. And this one, meanwhile, is denominated in US dollars. So again, fund types that we're seeing, we have fund of funds, portfolios, and a feeder fund. What's the difference? So for fund of funds, it means being in our fund is invested in various funds, more than one. But feeder fund is being invested in one fund only. So as we can see in the next slide, for our actively managed funds, which are the fund of funds format, these follow this actively managed investment approach. So what we do here is we have we can source we use different tools or funds to express our view on the market, and there are three ways wherein we can generate an outperformance versus the broad index, the MSCI ACWI. So first that we use would be an asset allocation. So for example, we have a balanced fund of 60% equities. That's for the Dollar Advantage Fund. We can go higher than that and allocate more to equities if we think that will perform better than the other asset class, which is fixed income. That's one tool. Next, we have country selection. As Jimmy mentioned, for the MSCI ACWI, it's about 60% is invested in the United States. And if we are more optimistic on the prospects of the US, we can go overweight in that market to increase our outperformance. And then finally, another leg of another tool that we can use is selection of funds. So there are thousands of global funds out there that we can invest in, and we try to choose the best ones that align with our view, that align with the themes that we want to invest in, and select those to express our views in the portfolios. Okay. All right. So now that we have a grasp of the Sun Life funds, let's go back to the outlook presented earlier and see the implications to our portfolios. So here we see that inflation has been moving lower for quite some time now, and this gives the US Federal Reserve some room to actually begin cutting rates. So overall, this inflation backdrop provides support for risk assets in general. In fact, in recent months, as we can see in the next slide, the markets have been more optimistic in terms of the number of cuts that they are expecting out of the Fed. So previously, as of previous quarter end, markets have been expecting just 1 to 2 rate cuts from the Fed, but now this has increased to about 3 to 4 cuts by year end. And unless we see a big deterioration in the US economy and the global economy, more cuts would mean more supportive for risk assets in general, both equities and fixed income. And we can see in the next slide the different asset class average returns 12 months after the first rate cut of the Fed. So here we see the first 3 bars there. Those would be your fixed income sector. So you have US high yield, US investment grade, and global fixed income, all delivering high single digit to low double digit returns, while the last 6 would be some equity markets. MSCI Asia, ex-Japan, emerging markets are leading at 24%, S&P 500 and MSCI World 19%, and the broad global equities market at 30%. So overall, we could expect strong returns from global markets after a rate cut. So this again is historical returns. And so with that, with higher yields expected to come down, what could also be an effect for equity markets is increased demand. So previously, with yields being high at their current levels, of course, investors would tend to lean towards those higher yielding funds because they have lower volatility. But since we expect these yields to come down, that gives the premium for equities, the equity premium goes higher, and so that could increase or unleash some more demand for equities moving forward. And so by investing in equities, you have that higher risk premium. And so here we present our return expectations for the rest of the year for global equities, with the base case or with an earnings expectations of 8% for the remainder of 2024, and PE multiple assigned of 19 to 20 times. So that's around the 10-year average. We could see ACWI moving to 880. So that's our bull case target, which is around 6% from current levels. So again, with strong earnings as base and an expansion of multiple because of expectations of more easier monetary policy, we think we could reach that 880 level for MSCI ACWI. And so we would like to, in the next slide, you would like to show the sector allocation of our global equity funds. So this is the World Voyager versus MSCI ACWI. And here we are tilted more towards information technology sector, consumer discretionary, communication services, as well as healthcare. So those are the top overweights of the fund. The first three being beneficiaries of the AI theme growing, with the AI theme moving from just benefiting hardware companies, but also to the applications later on. And then for healthcare, we see some healthcare companies continuing to receive strong prescriptions of breakthrough drugs like drugs for diabetes and for obesity. So those would be the top tilts of the funds that we have. Meanwhile, in the next slide for our balanced portfolios, so those would have the equities and fixed income, we are all overweight on equities. So for example, the Dollar Advantage Fund, which has 60% in equities, we are around 63% invested here. And then for fixed income, of course, we can be overweight on both asset classes because we have limited cash. We express this overweight call via extending our duration by investing in longer dated fixed income securities. And then below, in the table below, that would be our allocation, geographical allocation for the global equities. We are overweight in the US. We are optimistic on the US, Japan, and Asia, ex-Japan, ex-China. So we think that the rate cutting cycle by the US will benefit corporates in the US as we see their corporate earnings be boosted. And then Asia is also a strong beneficiary of those, as we've seen in the graph shown earlier. Also, the tech theme is prevalent in Asia. In some parts of Asia, as mentioned by Jimmy, Taiwan, Korea, those would also be beneficiaries. Japan is also an overweight for us. We like Japan because of their consumption story and their corporate governance improvements, which are trickling down to better corporate earnings. Meanwhile, Europe and China are underweights. We don't think there's much catalyst in the Europe, and for China, still has a lot of property woes and weak sentiment going around. And so finally, in my last slide, some key takeaways from my presentation. Hold on. Yeah, there. So first, again, we expect the US Federal Reserve to pivot in terms of their monetary policy. That is to start cutting rates in September. And this should be beneficial for risk assets in general. Second, profitable. Corporates remain profitable. We expect their earnings to go to deliver 8% earnings growth this year and even higher next year at about 12%. And the artificial intelligence team could be a big driver of that growth. And barring any hiccups from the monetization or implementation of those technology, then those earnings expectation could provide a boost or a base in terms of returns expectations for the markets. Third, of course, uncertainty is something that is constant in this market. And we think with geopolitical tensions and the upcoming US elections could add volatility in terms of the movement in asset prices. And for a long-term investor, that could serve as good entry points in adding to our portfolios. So again, stick to your plan and then use those times to increase your allocation. And finally, diversify, not just within another asset locally, but diversifying globally to have exposures to innovations that are happening worldwide, especially those that are not present in our local markets. That's all. Thank you.
All right. Thank you for sharing your insights, Nick. No, especially the part when you showed the tech sector allocation. I'm sure all the investors were wondering how much of exposure we have to the tech sector. All right, let's go straight to the fireside questions. No, Jimmy, could I call you back to the floor so we could address some of the fireside questions? Okay. So in our first question, I know we already discussed some of these things earlier, but maybe for those who arrived late, we wanted to just give some emphasis or recap some of the main points. So if we can go to the first question. Now that Fed Chair Jerome Powell said it's time to cut interest rates, in a gist, how do you see this affecting global equities and global bonds over the medium term or maybe even the long term?
Yeah, thanks, Mon. Yeah, and it was a really good, insights from Nick there. And she also highlighted as well the policy pivot. It's a tailwind to both equities and fixed income. She also highlighted that, while both asset classes have done well, equities actually have emerging market equities historically have done even better. But I think, with this quote, it's time to cut interest rates. I think markets overall have gotten excited. It's a risk-on asset class move. One of the key things to really note that, is the timing of the cut and the rationale behind it. And so if the Fed was cutting interest rates because he was expecting, perhaps a recession or this was a crisis period that wasn't priced into the markets, perhaps equity markets would react negatively, right? I think there was talks at one point where there would be an emergency cut because of, recessionary fears. That would be a negative. Right. Here, we are saying that this is a time to cut interest rate to support the economic growth of the US economy. And so that's why this turns into more of a positive. And the rationale behind why this is quite positive for both asset classes, particularly for equities, really is because of this tailwind where there's lower borrowing costs. And ultimately, the equities would look much more attractive, compared to fixed income. And emerging markets overall, because you're seeing, especially with ASEAN markets, in the past month, best monthly return over the last several years within ASEAN markets due to the Fed interest rate cuts. You saw Philippines, you saw Indonesia, you've seen Malaysia, Thailand. A lot of fund flows basically coming into these markets, again, because of very low ownership, very low valuations, and more value attractive opportunities that previously I think investors have been really waiting for that message from the Fed. So overall, I think historically has shown a very similar pattern, and we are, quite positive and positioned, for more of a positive impact on both equities and global bonds.
All right, thank you for that, Jimmy. So in a nutshell, it's a positive thing for both equities and for global bonds. Now,
Right.
for the next question, I know, Jimmy, you had two slides on this, no, but for maybe those who came in late, um, do we think that the market volatility we saw 2 weeks ago was just a one-off, given how extreme it was? I know, was it overdone? Was it exaggerated? And maybe you said it was profit taking. Could it just be that? With prices being very high, do you think we may see more of these episodes in the future?
Well, we'll definitely see volatility, right, within the markets. I mean, that's just a natural function of investing into equity markets, that it's always exciting. You're always going to have some, volatility due to, certain events. I think what we saw in the last couple of weeks was really a number of things really coming together. It was one where we had, I call it a crowded trades within, Japanese markets. So there was a, change in regime that I think investors were concerned about, that it was no longer cheap to borrow, right, in yen and basically reinvest that into other risk, assets. There was concerns about, the technology sector because of, higher valuations and the spending on capex, especially with, second quarter numbers that came out. And then there was concerns about whether the U.S. economy could really hold on, right, because of the unemployment rate situation. But I think, as all of those basically got addressed, and I think, again, markets tend to sell first and ask questions later. Now they're basically saying, okay, well, is this really a recession? The answer is essentially, we're not seeing that as a real risk. Is the employment situation that negative? We're seeing a slowdown on consumer spending, but it's not to the point where we're seeing emergency rate cuts, right? So I think the tone has moderated. Volatility has moderated. The Fed basically came out and said that they're supporting, the market. So I think, overall volatility will likely return, but due to different reasons. And again, recession talks and fears will likely come back, right, due to various reasons. Maybe it could be an inflationary pressure. Maybe it could be geopolitical risk. Maybe it could be a policy, right, that comes out from the U.S. elections from, either candidate. But I think the key thing about that is really just making sure, like, are these risks that have an impact on corporate fundamentals and earnings? And then we'll see whether how the market will react to that. But I think that it was excessive that we saw 2 weeks ago. Generally, it would be for a different reason for market volatility, but I would probably see that we wouldn't see such a large spike, right, due to a number of factors that came together, but definitely see much more volatility coming forward, I should say, because of the increase in uncertainty as a result of new policies and elections.
Right. Just staying on this question first now, because I wanted to emphasize something further. Just a follow-up question, Jimmy and Nicole, if you ever you want to add something here, you feel free. Okay. I just wanted to know if like your other investment teams across the region were taking it as a buy the dip opportunity. Was that something going on during that time? Because the drawdown was really excessive.
Well, I'll start first. Right, just purely given that I have visibility on our equity portfolios across the region. What we did during this period was remain disciplined, right? We wanted to monitor and evaluate the situations. This could have been a situation that have exacerbated a little bit more, really just because of a fear factor. The momentum within that, we understood that this was not fundamentally driven. This was really more of concerns, focusing on expectation fears and also growth concerns. And so, I think when we started evaluating whether this was warranted, we monitored this as an opportunity to really be able to buy on dip if this exacerbated. But I think, we weren't looking to aggressively add into every dip, within the market, right? We will look into opportunities, if it presents itself as the risk reward becomes much more attractive. So, for us, it was more about just playing the position, I think the scorecards and the weights that, Nick showed earlier within our key markets, remaining disciplined within those and being able to take advantage if the markets continue to sell out further.
Okay. How about for you, Nick? I know that we were heavily overweight on Japan, right? And Japan Nikkei extremely dropped during the last 2 weeks. Were you taking that as an opportunity to buy more during that dip?
Yeah, I think agree with what Jimmy said. No? We remain disciplined during this time. So the initial reaction may be to sell some overweights to trim our exposures right away, and then in case it exacerbates. But I think with more reading up on what's happening and understanding that it may be technical in nature, we took this time to add to our exposures in a cautious way, not really going massively overweight in those markets. So we added in US and some in Japan. And we've seen the US market already recover, or maybe overcome the previous levels already. While for Japan, it still remains subdued because of the currency risks that's still in play.
Okay, thank you for that. We can skip the next question already and go to the next one after that. So yeah, we can skip this one already because we already covered that. So in the next question, I know Jimmy, before we've talked about this, and you said that we thought that emerging markets may outperform developed markets like the U.S. Is this something we believe in today, or has the view changed already?
Yeah, so a lot of factors really playing into this, right? I mentioned a lot of positives for emerging markets, particularly for the ASEAN markets. Very low valuation, so you're trading against historical averages, one standard deviation below, versus the US when you're trading one standard deviation above. And so I think, from a valuation perspective, from foreign ownership perspective, it looks quite attractive. But again, investing into emerging market has its risk, and it goes back to the political stability risk, the liquidity risk, the currency volatility. Are these things that I think foreign investors are able to get a higher return for the risk that you're taking on by investing into emerging markets? Now, with the Fed rate cut, and also with I think the U.S. elections coming into play, it probably looks like the rate cut would be beneficial, right, for emerging markets. Really, that this is more of a risk-on scenario that we saw ASEAN markets, again, having one of the best monthly returns, and we're seeing very strong inflows, and strong local currencies versus the U.S. dollar because of an expectation of a U.S. rate cut. But at the same time, the U.S. market and technology sector that we've been talking a lot about during the session still remains quite strong with the key fundamentals intact. And so, emerging markets, again, don't have a lot of exposure in tech. It doesn't have a lot of growth, exposure, and doesn't have a lot of thematics in AI. And so I think that, while there's some stability and inflows into emerging markets, we need to start seeing the growth aspects and the positive impacts of technology ripple into emerging markets. And perhaps, when we start seeing that US markets become a little bit less favorable, that emerging markets become a little bit more positive compared to the US, then we'll probably start to see that as more of an outperformer. But this is more of a long term. I think I showed it on the second slide. The research was showing 2050 and 2075 emerging markets become a key part of that growth is not happening at the current moment because the short-term growth, I'd say over the next, especially next, 4 years with either, candidate, in the White House, there'll likely be more US focused and US centric. And so that would probably be much more beneficial with protectionist policies, within US companies. But I am quite optimistic over the long term for emerging markets. I think in the short term, though, the technology sector that we talk about, the US policies, and the election probably is much more favorable for more developed markets like US.
All right, thanks for that. Now, staying on you again, Jimmy, because I know you talked about tech, and I know you had a slide earlier, but for the audience appreciation, how different is it this time with the tech rally? If you can go to the next question, please. How different is it this time, this tech rally, comparing to the dot-com bubble in 2001? Do we think tech will remain to be the driving force of the global equity rally now with the Fed rate cuts? And please feel free, Nicole, to give your sentiments also with this.
Well, I think Fed rate cut is really just supporting, higher multiples and more of a risk on, scenario, benefiting both, again, equities and fixed income. The tech sector, again, is kind of going back to the fundamentals. Whether there's a Fed, rate cut or not, I think that the profit growth will still be intact. We think that the earnings cash flows for a lot of these technology companies will still be supporting or even covering, a lot of CapEx spending, over the next, few quarters. And I think there's going to be a lot of balance within a lot of the technology companies and a sector overall where they need to basically balance how much they're spending on CapEx and how much they're able to monetize that over time. Because ultimately it's a little bit like the Fed. You can essentially be able to support, right, earnings by basically cutting back on CapEx. But right now there's a lot of spending on it because they see the potential. I think AI and technology, particularly, is not really just more of a short-term speculation. It's a trend. Whereas when you look at the dot-com era, it was more of companies that were not generating earnings. They were very loss-making. They were not being, and if you look at its market cap compared to its earnings, it was basically kind of blown out. Compared to currently, a lot of these technology companies are actually real businesses with very strong profits and very good cash flows. And so that has been able to support the R&D investments and CapEx to invest into the future growth. And so, I think, Fed cut or not, again, technology will still be, doing quite well, but the Fed cutting rates definitely will support and be more of a tailwind, for technology sector, particularly within the US.
Right. So I guess what everyone here is listening to, what Jimmy's trying to say in a nutshell, if you allow me to say this, is that in 2001, the hype wasn't based on any fundamentals as earnings, wherein this time around, the hype is real because the fundamentals are sound and the companies that we are talking about, like Nvidia, have actual earnings to boot. Anything to add there, Nick? If you think that the Fed rate cuts would really boost the tech stocks now?
Yeah, I think Jimmy has said it all. We see the tech sector earnings expectations really strong. So it's not a question about how much they will deliver, but if they will beat their currently already strong earnings. So I think the tech sector will continue to be a driving force in global equity returns.
Right. And just staying on this one also, I know maybe you guys didn't, this is just something I just saw earlier that Nvidia is supposed to release its earnings, I think, tomorrow in the US. Is that correct, Jimmy? And it's something the whole market's waiting for, right?
Yeah, well, we'll see tonight,
Or
what
tonight, yeah.
happens there. So that's going to be, again, like the guidance there will be driving the momentum and also the trend as to whether this is a continuation of what we're going to see. So not just look at its current earnings. I think it's forecast to grow over 100%, both top and bottom line.
Wow.
But look for its guidance, right? What are they guiding for in the future? But quite positive again on what they're expecting to see.
All right. So in the next question, let's get to it here. How are the Sun Life global funds positioned for the upcoming Fed rate cuts? I'll just ask it to Nicole. Why are we inclined to invest more in the US and Japan, but not so much in Europe? Nicole, your thoughts here?
Yeah, so we've actually been waiting for the Fed to start cutting rates since for a long time now. I think you mentioned earlier, markets have been expecting this from last year. So I think part of this is already priced into the market, a portion. But historically, we've seen it still deliver strong returns for most asset classes. And that is why for our portfolios, we've been overweight. We've been overweight on our equities for the most part of the year. For fixed income, that will also benefit from rate cuts. We've been extending our duration. And for global equities, we are more inclined to invest more in the US and Japan, but not in Europe. We think the rate cuts will boost the corporate earnings of US, but we think in Europe there is less catalyst, or the sentiment is a bit weak, so that even if they're also in a rate cutting cycle, it will take some time before that trickles into their corporate earnings. And then for Japan, as mentioned earlier, we like the consumption story of Japan and also the corporate reforms here, which is improving the capital efficiency of companies, and that comes into better corporate earnings for Japan. But admittedly, we think the yen, the currency, is a bit of posing a challenge for the near term, but in the long run, we still think the fundamentals of Japan is intact.
All right. So thank you for that, Nicole. We'll just skip the next question and go to the final question now. And I'll just stay on Nicole for this final question now. Yeah, this one. Now, for you discussed this earlier, but for the audience again, for their appreciation, for those who are overly concentrated on their local equity-laced investments, would you recommend, given all of this market outlook now, rebalancing their portfolios to investments with more global exposures?
Yeah, maybe my answer is biased, but definitely I think this deserves a portion in everyone's portfolios. As we've seen earlier, there is a strong home bias to many investors, and it's worth taking a look outside to gain more exposure into themes that are not present in the local space, such as in information technology, in healthcare, things like that. So if you actually look at the composition of the PSE, this is composed of about 30 names. But if you look at MSCI ACWI, those are about 3,000 names. So instantly you gain that much diversification by going outside. But of course, aside from that, just the number, we see the prospects present in offshore markets. Again, the AI theme, delivering the Fed cutting rates is good for most markets in developed markets with less risk versus emerging markets. So I think maybe start with a portion, how much you're comfortable with, and then later on increase it, especially during market volatilities. So that would be good times to add.
All right, thank you for that, Nicole. No, so when Nicole said the MSA Acqui, that's the benchmark of the top 2,500 equity names all over the world. If you want to invest in that, we have a fund I'll discuss later called the World Equity Index Feeder Fund, available in Philippine pesos. All right, thanks, Nicole and Jimmy. Allow me to just finish up with some of the call to action slides over here as we go on over the closing of this webinar. So first, invest for rewards. Let's just talk about that for a bit. If you want to make the most of your investments this year, we have a great offer for those clients who are ready to invest in the Sun Life funds. For a minimum of 1 million pesos, you can get 6,000 pesos worth of giveaway EGCs. So that's every 1 million pesos, you get 6,000 peso worth of EGCs in any back-end loaded Sun Life Prosperity funds. The higher your investments, the higher rewards you'll get. Where can you use the giveaway EGCs? You can use it to buy, purchase, and avail of products and services from more than 14,000 merchants of giveaway. And this month, we are featuring GCash Load. So you can convert those EGCs to actual GCash Load. O, di ba? May investment ka na, may pang GCash ka pa. It's simple and easy to do. For more information about the promo, visit sunlife.co/IFR. The promo runs until December 27, 2024. So hurry, start making your investments today. You may talk to any Sun Life Asset Management financial advisor to make your way in your investing journey, or message us at phil-mfmarketing@sunlife.com. Let's talk about GCash bills payment in the next slide. Speaking of GCash, did you know you can already top up or add investments to your existing Sun Life Prosperity funds? That's right. With just a few taps on your GCash app, you can grow your money and stay true to your investing habit to reach your financial goals faster. Just go to bills payment on the GCash app and tap others and search SLAMC, SLAMCI. Choose a fund and input your account information and transaction details. And that's it. You can do this regularly, anytime, anywhere, and at your own convenience and pace. To know more, visit sunlife.co/slamc-gcashbp. And now, let's talk about one of our newest funds, which has just turned 1 year old already as of August 22, 2024. Good news to all investors of the WIF or the World Income Fund. We just turned one already, and we are proud to announce that since inception, our fund has reached 4.78% in principal growth alone, while the main part of the fund, which is the cash payout, has already reached 4.23% since we started paying our investors from the fund's cash dividends. So that gives you a total fund return of 9.01%. All right. So this gives you a really good benefit if you want cash payouts on a monthly basis, and we hope you're happy with your brighter choice. So continue to invest and reap the potential returns from this fund, either from its cash payout or its capital growth, or both. So for those na wala pang whiff, guys, after this webinar, we hope you've gathered insights from Jimmy and Nick to help you decide to invest and diversify to global funds. If you want to know more about WIF, just go to sunlife.co/WIF or WIF. So far, it's one of the best-selling, if not the best-selling SLAMC fund right now. So don't hesitate to go to the link and start learning about the fund. Our Sun Life financial advisors are here to help you make the move to WIF. Now, let's talk about another top-selling fund. Earlier, Jimmy and Nicole have been talking about the MSCI Acqui, and this is the fund we're talking about now, the World Equity Index Feeder Fund. Ito naman, for those investors who are willing to accept higher risk for higher returns, the WAIF or the World Equity Index Feeder Fund, which is composed of the top 2,500 companies in the MSCI Acqui. 21% tech sector po siya and 12% health sector. It has already reached almost 70% return since inception of August 22. So, We posted this in the Sun Life Facebook page and hope nakita ninyo. This was launched actually in July 6, 2020 in the pandemic, no. So if you're looking for a fund which is heavily invested in tech stocks, and we know the opportunities presented by having exposure in this sector, just like what Jimmy and Nick discussed a while ago, this is your chance to ride the wave of opportunity of investing in Microsoft, Apple, Nvidia, Amazon, Meta, and Google for only 10,000 pesos. Subsequent investments are for as low as 1,000 only. You can keep this in your portfolio to provide you that kicker when you want higher returns from the tech stocks. Just go to sunlife.co/wave to know more. And now let's go to our one of our top selling dollar denominated funds called the Dollar Advantage Fund. Nicole mentioned this earlier. This is our global multi-asset fund, 60% global equities, 40% global bonds. If you're looking for a global fund that has a proven track record in its fund performance, here's another fund which has been recently awarded by the CFA Society of the Philippines as the best managed fund in the balanced fund category, dollar denominated, for 2021 and this year, 2024, the Sun Life Prosperity Dollar Advantage Fund. This fund is currently providing 7.58% year-to-date returns, 10.46% on a one-year return basis, and a 21.64% five-year returns basis as of July 31, 2024. If you want to know more about this fund, go to sunlife.co/advantage. Finally, just some reminders. This is about the investor suitability assessment. Just as an announcement for all SLAMC investors, don't forget to update your risk profile if you have been an investor 3 years or older. As part of making sure aligned pa rin ang mga investment strategies ninyo with your current risk profile, we want to encourage you to update your risk profile by taking our investor suitability assessment, which can be found in various digital forms where we have whenever you want to add or switch funds. For those who are new investors naman, you can do this during the account opening process via the MFE app or the account opening digital forms. Once you're done with this, you can enjoy hassle-free investing each time you add or switch fund the next time you transact with SLAMC. Updating is required once every 3 years only. And finally, let's talk about the MFE app, no? Our purely online do-it-yourself account opening tool. We mentioned about this earlier already. So this is for new and aspiring investors who really want to invest through a pure online method. We have a digital platform waving at you. It's called the Sun Life MFE app. You can take your ISA or that investor suitability assessment, submit your account opening details, upload a selfie and ID, and lastly, pay using BPI or Paynamics to fund your initial investment in your selected SLAMC fund. In a few minutes, you'll be on your way to a bright investing journey with Sun Life. Invest anytime, anywhere, and the maximum amount you can invest here is 300,000 pesos initially. Finally, we're talking about the MF 101 now. If you want to know more about how mutual funds work, or if you want to share this to your friends and relatives, we have an upcoming event on September 18 at 10 a.m. It's called MF 101. Here we'll discuss the basics about the various fund asset classes featuring each mutual fund and what benefits can you get from investing in each of them. We'll teach you ways on how you can start investing based on your risk profile and how you can become investors of the future and build your own portfolio. So if you want to get that investing vibe, we encourage you to attend this free webinar and ask away your questions to help you make the right choice and achieve your financial goals with Sun Life. And there you have it, folks. We'd like to thank our guest speakers, Jimmy Weng and Nicole San Juan, for their time and sharing their views today. And a big thank you to all our guests, clients, advisors, especially those who stayed with us until the end. If you want to know more about our global funds, please reach out to your financial advisor. Again, my name is Monos Menya, and on behalf of the SLAMC team, thank you for coming. This event has been brought to you by Sun Life Asset Management Company. Stay safe, everyone.